Hi, everyone, and thank you for joining us today for the Saxo's webinar with NASDAQ, how to monitor and adjust your portfolio. My name is Ida Johannesson. I'm head of commercial ESG and education at Saxo, and I will be the moderator. Today's webinar is part of a series. We've previously covered the importance of investing, the main investment products, and just last week, how to build a portfolio. And today it is my pleasure to be joined by our speakers, Ephraim, Ilaria, and Jakob. Ephraim, I hope you can see my screen. Let me just double check. Yes, it seems to be working. Ephraim is a Vice President, Global Head of Index Research at NASDAQ Capital Access Platforms. Whew, that's a mouthful. Ephraim is responsible for content strategy and direction, covering NASDAQ's index lineup. In addition, he's responsible for index partnership and methodology research. Ephraim joins us from Connecticut in New York, where it is 7 o'clock, I believe. Hi, Ephraim. Hi, Ephraim. I hope you're doing well and you've had time for a coffee. Sorry, we cannot hear you. We seem to have some issues with the sound. I'll just go to Ilaria and then hopefully we can solve your issue in a minute. Next is Ilaria. Ilaria is Index Research Lead at NASDAQ Capital Access Platforms. She's part of the team that provides research and insight on NASDAQ's product suite. Ilaria joins us from London, and she's originally from Italy. Hi, Ilaria. Good to have you. I'm sorry, I cannot also hear you, Ilaria. Can you please just write in the chat if you can read us or not? It would be a shame if you cannot hear anything. Jakob, can you hear me?
I can hear you. Can you hear me?
Yes, I can hear you, but Ilaria cannot hear you, and I could not hear Ephraim. We'll just give you a minute, and then I'll move on to Jakob in the meantime.
Can you hear me now?
Yes, we can hear you now.
Okay.
Great.
Can you hear me now too?
Yes.
Yes, and we can hear you too, Ephraim.
Perfect.
So next is Jakob, last but not least. Jakob is Global Head of Investment Strategy at Saxo. He's responsible for investor content and has experience in portfolio construction, investment strategies, macroeconomics, and market dynamics. And Jakob is based in Copenhagen. He actually sits just a few desks away from me. Hi, Jakob. How are you?
Hi, Ida. Great. Thanks for having me.
Great. All right. The agenda for today's webinar is as follows. Our speakers will walk us through portfolio monitoring, tools and techniques to monitor our portfolio rebalancing, and lastly, rebalancing strategies in indices. At the end, we have reserved 15 minutes for a Q&A. You can ask your questions anytime during the session. Just type them in the chat. If they are pertinent to what the speakers are talking about, then I'll ask the question there and then. Otherwise, we'll take it at the end. And then we have a short survey. Would greatly appreciate if you could take a minute to provide us with your feedback. It helps us improve and serve you better. Now, before we get started, just some important information. Today's webinar is for educational and informational purposes only, and not a recommendation to buy or sell any securities. Investing involves risk, including the risk of loss. Past performance is no guarantee of future results, and before investing, you should consider your investment objectives, time horizon, and risk appetite. And now, for good order's sake, I'll also pull up the NASDAQ disclaimer, and I'll leave it here for a minute for you to review. But in any case, you can you can read through the disclaimers in detail because these slides are available for download. So please free to download them. All right, so now let's get right into it. Maybe we're going to start with you, Jakob. What is portfolio monitoring and why should investors monitor their portfolio?
Yes, thank you, Ida. First of all, I would say many investors have a tendency to assume that once they have set or build a portfolio, they can simply just set and forget it, you can say, and then it will grow nice and good returns over time. I'll just try to share my screen here as well so I can show a slide. Because I have an analogy here of a garden where if you just plant a nice garden, eventually it will overgrow. Eventually it will not look like you initially planned it if you're not pruning it, if you're not monitoring it, if you are not keeping it, so to say. And you can say it's the same with your investment portfolio. So over time, markets develop, you develop as a person. So there's a lot of things that you should take care of. Your financial objectives might change. So there's a lot of dynamic things when it comes to investing that you need to take care of. You can also, I mean, now I talked about a garden. You can also say or look at it like a health check for yourself. You would like to go to the doctor from time to time to get a health check, and not only when you're very ill. So you can say that's the same with your portfolio. So you should keep that in touch, and you should all the time, not all the time, but you should regularly check into it, whether it's performing the way you want, whether the risk is still in line with your objective or your risk profile, and whether it still fits you and whether it actually gives you the returns that you want. So that's why it's really important to can say monitor it on an ongoing basis. Should I just keep going with the next one? Yeah. Okay. So what are you then looking into? Say that this is what I basically just said. So you need to prune the garden. But what are we then looking into? As I said, the investment's objective. That's the first thing. You need to ensure that your portfolio is still fitting your financial needs. Have something developed in your life? Have you just had a kid or a baby? Are your kids moving away or moving away from your house? Are you closing in on retirement? Anything else? Do you have lost your job? Do you get a new job? Something that is, you can say, changing the financial objectives that you have. Then you need to make sure that your portfolio is still fulfilling the financial needs that you have, and it's still the right one for you. Then the next one is, of course, risk. Risk is a very important factor when it comes to investments. It's kind of the foundation for why we can actually get a return on our investments. That is the risk. So a lot of people tend to see risk as a very negative thing. That's actually the reason why we can expect a return on our investments. So not all risk is bad, but you of course need to keep track on the risk. Are you taking too much risk relative to what you are comfortable with? Are you taking too little risk? What is the allocation between stocks and bonds in your portfolio? Because as I just said before, your portfolio changes over time. So if you have a rally in stocks over a few years, for example, or a rally in a certain sector, then that uh, allocation between stocks and bonds or sector allocation or regional allocation, so on and so forth, will change over time. So once you, for example, you had a 50-50 portfolio, I will come back to that a bit later, but if you have a 50-50 portfolio, 50% in stocks, 50% in bonds, over time that will drift, and you might end up having a 80%, 70% stock exposure, which is, you can say, very high risk relative to the medium risk that you actually thought you had. So back to the garden pruning metaphor, you need to keep track on your portfolio. You need to prune your garden in order to make sure that the balance is still right. You can also, of course, look into things like volatility. is your portfolio suddenly more unstable than earlier? Volatility is like how much is your portfolio actually moving in value? And then the last thing to look for is, of course, performance. The reason why we invest is, of course, to get a return on our investment, to make our money grow over time. But it's also important to say, I mean, returns are not all. I mean, it's the most important thing is that your portfolio is developing in relation to your, say, financial goals and ambitions and objectives. So maybe it's not always worth changing the last piece of return or last percentage of return if it means you're taking on much more risk. So one way to do is like to look into, I mean, how is your return, how is your portfolio doing relative to some benchmark? I mean, relative to S&P 500, relative to global equities, MSCI World, or local index or something like that. Should of course also be looking into the individual assets in your portfolio. So you have the different stocks. I mean, which ones are performing, which ones are not performing, and so on and so on and so forth, so that you can actually, yeah, of course, keep the stocks that you actually believe in, and maybe get rid of the other ones if they're not performing, say, relative to your expectations. So.
Okay, I guess as an investor, I understand the importance of risk monitoring. You've covered the why. Can you just tell us a bit about the how? What are the tools and techniques that an investor can use to monitor a portfolio, Jakob?
Yeah, and what to look for, I think also is also important in terms of this. I put in here some key metrics that you can track in order to look into the risk or the return or on how you are performing, and many of these you can of course see in your investment platform, in Saxo platform as well. So one thing, for example, like volatility or the standard deviation, that's kind of a statistical measure of how much your investment is fluctuating over time. So if you have a high volatility, high standard deviation means that you have high up and down moves in price. That says a little bit about, I mean, how much is this actually moving over time. It doesn't really say so much about like the return. You can say all else equal, we have the kind of link that if you have a higher risk, then you should also have a higher expected return. But that is all else equal. But you say if you want to go in to see, okay, how am I actually performing, or how are my investments performing relative to the risk that I'm taking? You could be or you could get a very high return on your investment, but you obtained that high return by simply gambling a lot or taking on a lot of risk, a lot of standard deviation. Then it's not really, say, that well performed. But if you can generate a high return for low risk, then it's much better. And there we go into the Sharpe ratio to see how much return are we actually generating per amount of risk we are taking. So that's kind of a risk adjusted performance measure. So it's you can say a little bit better to look at for investors, because it tells you a bit about how much risk adjusted return you're actually generating. That is also a good thing to look at, for example, when you look into funds or ETFs or something like that, because it gives you a better understanding of the performance of this fund. And you can say a higher Sharpe ratio is better, because it means you earn a higher return per unit of risk that you are taking on. And the Sortino ratio is kind of the same, but it focuses a little bit more on the downside of the risk. So it also, you can also use that one. Then there's the beta. And beta is also a bit technical aspect here, but it, you say, basically it measures how much your investment moves in relation to the overall market. That could be S&P 500, that could be the global MSCI World, but it measures, I mean, if the market is moving, how much are your investments moving as well? Is it moving more, or is it moving less than the market? So if you have a high beta investment, then it could give you bigger gains, but also, yeah, as written here, bigger losses. Whereas a lower beta investment would give you more stable returns in general, you can say. So these are some of the measures you can use to track, for example, things like risk and return. If you go into, for example, the diversification allocation, then you need to track, I mean, how is the allocation in your portfolio. As I just said, over time markets develop differently. Some asset classes develop in one way, some regions, some sectors are performing good or bad in some kind of market environment, and that means that your investment will drift, or your allocation will drift over time. And that is, of course, something that is affecting the level of diversification in your portfolio, and it's also something that is changing the overall risk level in the portfolio. So first of all, you of course need to make sure that the right allocation between asset classes, so equities, cash, fixed income, is still the right one here. And I have an example from the platform, the Saxo platform, where you can see that equities make up almost 70% of this portfolio. No fixed income, a little bit of cash. If we look into the country perspective, US is making up the vast majority of this one, a little bit in Europe as well, and then technology is large with the sectors. But over time, this may drift. You can also, for example, I think this represent a global ETF. But if you have like 3 or 4 or 5 single line equities, then your diversification or your allocation might look very, very different. But over time, it's important that you keep track on this and see, okay, do I have a very high exposure towards some kind of sector, towards some kind of country? A lot of investors tend to focus a lot on their own countries and their own home markets, meaning that they will have a significant home bias. That would be in Denmark. A lot of people would tend to have a significant portion of Novo Nordisk stocks, for example. That could make up almost a third of the portfolio in some for some investors, which of course means that you have a very high idiosyncratic risk, because you have a high, you can say, first you have a high exposure towards one single name, you have a high exposure to one certain market, but also in the healthcare sector, for example. So it's important over time to keep track on both the asset classes, the country, regional exposures, and then of course the sector exposures as well. I think you're muted, Ida. I can hear you down the line.
Okay, sorry about that. It always happens. So I was just saying that, all right, we understand that it is an important step after building a portfolio. One must keep an eye on it. But the question is, how often should an investor monitor a portfolio? And maybe I'll ask that question to Ephraim.
Thank you. And glad to be here. And I guess I'll just kind of start off by kind of reiterating. So glad you can hear me. Reiterating that, from the disclaimers, right, that this is for educational purposes only. And so these views are mine, not of the companies, and also, right, that involving ourselves with the risk and so forth, and as we laid out in there. So thank you again. And so in terms of monitoring the portfolio, it really depends a lot. Jakob was saying a lot of great points on what's your risk tolerance, what's your investment objective, what are you trying to actually have your outcome be? And that's actually a lot of where indexes come into play for folks, right? It's a big part, right, of an index being constructed, right? There are a number of things, right, when you have created an index. And first off, an index, right, is generally a basket of, excuse me, an index can be a number of things, right? But when it comes to financial markets, right, it's generally a basket of investable securities. And what an index is usually set up, it's usually rules-based, transparent process. So it'll go through, right, periodically, have a set, what we call reconstitution. It'll also have a set time where we look into what we call index rebalancing. And why is that so critical? Again, so much of what Jakob was hitting at before, it's ensuring that the investment objective, as laid out in when it comes to indexes within the methodology, or when it comes to individual person and persona, what are you thinking about? What are you trying to get your objectives to become? And how often do you want to do that, right? It's really up to what your outcomes are trying to be. So if that is meant to ensure a certain type of risk tolerance, if that's a certain portfolio performance outcome, those are the types of things to keep in mind. Now, one of the things I'll just kind of take on what Jakob was saying and just kind of reiterate and hit home too, when if volatility is a big part, you might hear that word so much in the media or in the news or written and so forth. Volatility can be both bad and good. So it really depends upon what your outcome is, because again, volatility can certainly be on the downside, but in many cases, it can also be on the upside, right? Because what all volatility is showing is what's the measure, right, of this bouncing back and forth. And if you're bouncing right up, that's a very good thing. You don't necessarily want to trade away from the bouncing up, or are you trying to trade away when you're bouncing down? So volatility, it's a matter of making sure what you're actually looking to gain exposure to, right? I'd say that is the part when you look at monitoring. Are you trending down? Are you trending up? How often do you need to look back? And again, a lot of that is up to the individual and their objective. Another thing that I'll take about what Jakob said that was that I really like that'll hit home on when it comes to putting your garden or going to the healthcare checkup and talking about a great company example like Novo Nordisk. It's ensuring that if you are invested into products and you also have individual security exposure, it's making sure you take a look at the totality of your portfolio, right? Because there are many cases that you can own individual security, and then also you might own in many funds or other investable products, right, that track indexes or otherwise, that you're actually going to have exposure to some of those individual names. And it's ensuring that when you look to monitor the portfolio of the investments that you have in your basket, right, inside of your accounts, it's ensuring that you're not overexposed. That's the whole point of diversification. It's saying, well, if I have that Novo Nordisk exposure and I own this wonderful set of funds, what's that additional exposure actually look like to that company? Am I overexposed? Am I underexposed? Do I want to have more weight? And again, that's where you want to tilt the dials up or down. That's what rebalancing is about, and that's why it's important to monitor. And frankly, again, depending upon the person, when you want to, is it daily? Is it weekly? Is it monthly? Is it quarterly? Is it yearly? Again, it really depends on the individual. Here at NASDAQ, we offer over 10,000 indexes, and we have a range, right, depending upon the objective of the index. In most cases, right, indexes are looked at anywhere from generally, right, quarterly to annually, right, with respect to rebalancing. So certain indexes, right, that have more tweaks and levers to pull due to, again, certain setups and their objectives, they can be reviewed as frequently as every week or two. Doesn't mean they're going to actually be rebalanced, but they're reviewed and monitored for that.
You are muted again, Ida.
Holy schmoly.
But if I can just add one thing to what Ephraim was just saying, in terms of how often you should look at or monitor your portfolio, I think I can only echo what he's saying, but I also think it's very important in terms of, what is your objective? What are your investment horizon as well? So if you are a very long-term investor, you are in this game for, let's say, 10, 15, 20 years. If you go in, for example, if you buy a diversified portfolio, MSCI World tracker, something like that. Overall, if you go in and watch or monitor your portfolio every day, approximately half of the days you would see a negative return, even though over time it mostly go up. And you can say, so if you go in and watch every day, then it will actually be pretty hard for yourself from time to time to follow the long-term strategy, and then you have the time to you have a tendency to maybe forget the longer perspective or your time horizon as a private individual. So if you say on a day-to-day basis, approximately half of the days have a negative return for the global market, but if you look on a 15-year horizon, then global equities have never seen a negative return. So it's just important to remember your, if you say, long-term objectives. Is this one or is this investment something I need within the next 3 months or next 10 years? Then it's just it's really important to remember that when you go in and monitor everything, and you, because a lot of people have a tendency to say downgrade the investment horizon as market volatility spikes.
Yes, indeed. All right. Now that we've covered the monitoring, maybe we can look into portfolio rebalancing. Jakob, can you please explain to us what portfolio rebalancing is?
Yes, I'll just make sure my screen comes back on. If I'm just put a few words on it, and we also touched a bit on it before, but you can say portfolio rebalancing is kind of the process of restoring your initial asset allocation or allocation in the portfolio such that it fits your strategy, such that it fits your overall plan, and such that it fits your investment objective. You can say, I also touched a bit upon it before with this pruning of the garden and health check. One of the, as I said here, one of the overlooked dangers is that over time, risk changes in the portfolio. The risk changes in the portfolio if you're not doing anything. So you can have a perfectly well diversified portfolio, and if it just stays put over time, it will over time be more and more concentrated, and it will end up being much more risky to you, because certain asset classes or certain sectors move differently. So you can see over at the right side, I just put in a hypothetical portfolio of 50-50% stocks and bonds. And there you can see that over time, this will drift if you're not doing anything. So if you have a medium risk tolerance, medium risk appetite, you have a 50% portfolio with 50% stocks, 50% bonds, then over time it will suddenly drift, and then you could end up having 70-80% equities, which means that you're much more exposed. So if something is something market volatility is there, if you see a certain market drop, then you will suddenly lose much more than you initially expected. It could also be the other way around. So if you have a period of I can say declining stock prices, then you could end up having only 30% equities, and then it will take much longer time to reach your financial goal over time. So you can say portfolio rebalance is kind of the process of going back to that initial state. So where we talked about the monitoring before, the rebalance is actually just adjusting back to that level that we talked about. So as I wrote here, it prevents that you don't build up too little or too low risk, and also ensures that you can kind of lock in the gains that you have, and keep the risk level aligned all the time with your, say, comfort zone and with your objectives and your risk profile. And overall, it will actually, there's a lot of factors there, and there's a lot of research into that, but it may also improve your long-term returns actually, and have a example on that later as well. But that of course depends on the exact period. But we say the most important is to help staying disciplined and help your risk level being intact.
And if I may jump in on that too, Jakob, again, some of the things that back to you said at the beginning, right? Your 50-50 mix, right, could also change, right? Maybe you want 50% stocks and 50% bonds at a certain point in your life because you're looking to have certain allocations and outcomes, right? But all of a sudden, maybe you're actually not interested in fixed income, right? And that 50% fixed income now is 25% equity and 25%, I don't know, options, embedded solutions, whatever the case may be, right? And then all of a sudden you're 75-25. Nothing should still change from everything we were talking about here, though, is how often should I be monitoring and looking at my portfolio? When do I want and feel comfortable with everything? When do I feel like I need a reset, that I'd actually have to go in and tweak allocations here or there? Sometimes it's a small tweak, sometimes it's a big tweak. And again, that's when one of the things that I love about indexes, it's done for you, right? It's a part of our process where as of a certain part in the calendar, you can look down and say, this time of year, this is going to occur. This index is set up such that it will actually go through and make that change for you. So as an investor, for someone that's tracking indexes, the work's done for you. All you need to do is, frankly, directly track that index, either by yourself or by virtue of buying products that track it. And then the key is, of those, if you like almost everyone in the world does, if you're owning multiple products that track indexes, it's ensuring that mix is then rebalanced and set back.
Okay, so if I understand what you're saying correctly, let's say I monitor my portfolio and I can see that things have changed a bit. Some positions or sectors have gotten bigger, while others have gotten smaller. So here, what I understand here is that I'm supposed to rebalance. Is that correct, Ephraim?
Yes, again, but it also depends, right? So if you were supposed to go back to 50-50, right, at each year end, and you did not do that, then yes, right? But if your objective changed, and again, if you're looking at it on an annual basis, and all of a sudden you said, you know what, I actually feel more comfortable with a mix of equities at this amount, and whatever, again, if it's fixed income or bonds on the other amount, again, so it really depends. But if you are looking to always say I'm 50% equities and 50% bonds, say as of the end of each calendar year, then at the end of the calendar year, if you're not 50-50, you go back and retweak, and and if you're above 50% for equities and below 50% for bonds, then you would go back and you'd trade to ensure that you were in line. And that's the same exact thing that an index that would be comprised of a 50-50 allocation would do.
Anything else you'd like to add to this, Ilaria or Jakob? Let's start with Ilaria.
Can you hear me now?
Yes, we can.
Just to add something.
But it's a bit faint. Sorry.
Can you hear me now better?
Yes.
Okay. So I would add that, first of all, we need to assess the change. So how much has the shift affected your allocation? Check if the weights have moved beyond your target. So if a sector should be 20% and now it's 30%, is still acceptable for you, for your risk tolerance. And then when you have assessed the change, you can decide on the action plan. You may decide to rebalance to restore, your desired asset allocation. You may decide not to rebalance and let the winners run, but you can set the limits, like via capping, or you can also do nothing if the shifts are small, and this can avoid excessive trading that could trigger, transaction costs, for example. You're on mute, Ida.
Okay, thanks, Ilaria. Let's go back to Jakob and hear more about rebalancing. Is it an easy exercise or is it a difficult exercise?
Unfortunately, it's not that easy. You can say overall the concept is quite easy, but there's some hiccups, and there is some things that makes it difficult for retail investors, at least, to do. One thing is the psychological biases. It feels weird to sell when it, say, if we go back to what a rebalancing is, you need to sell when the market is, going up, because you need to sell some of the equities to go back to the original allocation. That would mean that you, for example, should sell out equities when they are increasing. It also means that when market is dropping significantly, you need to buy equities to get back to the 50%, for example. So imagine that you were after the COVID, we saw a 25% drop in the market. You need to buy equities. Maybe it feels you can say counterintuitive to make that choice. So for a lot of investors, that is kind of difficult. And they can say that's a very important thing. And also you can say the next thing here, I mentioned it, like the fear of missing out. People would like to hold on to assets that perform well, so that is of course different. And then what Ilaria was also alluding to, like in terms of, the costs, you need to of course put that factor into play as well. You can't just, every time you drift 1%, you can't just trade back, because then you will have a lot of transaction costs. You will also have tax implications. That is also another factor that is kind of adding to complexity here, because of course, if you're selling an investment, it might trigger some capital gain taxes, and that could, of course, makes it difficult. We are not talking about, we should not go into like detailed tax advice here or something like that, but it's just something to keep in mind of. So overall, all of this makes it kind of difficult, at least for a lot of retail investors, to do rebalancing often and correctly. Maybe also because they actually lack a overall plan, and if you don't have an overall plan, then it's difficult to rebalance, because what do you then rebalance to? So that's kind of the starting point from this. So yeah, it is very important, but it's unfortunately also difficult for at least a lot of investors to do correct, and that therefore it's of course nice to be able to have some kind of help by buying indices or something like that, that Ephraim and Ilaria can speak a bit to in a second. I'll just add another example here, because what we also just briefly touched upon is, I mean, how often should you do this? Should you do it every month, every week, every year? Or as Ilaria talked about, I mean, should you do it when you cross some kind of threshold? And there's different ways to do this. You can do like a calendar-based rebalancing. So you can say every year, every first week of January, I will go through. You can also say I will do this 2 times a year, quarterly, whatever fits your you can say long-term objectives and your plan. Then you should go in and see if something has changed. And if nothing has changed, then you shouldn't of course do anything, because then you will just have the costs and taxes. You can also say I'm do a more ongoing monitoring, so I will do a threshold rebalancing. So you say if the balance between stocks and bonds, for example, drift more than 10 percentage points away from the initial allocation, then I will do a rebalancing back to the initial weighting. And then, of course, there's, as I talked about before, there are some taxes. You can use some other tax-efficient strategies to minimize the impact. You can use some tax wrappers or some other account types to do that. But the two first is the most relevant here. So set up some kind of strategy that you have for yourself that works for you in terms of your objective and your long-term perspective. So how often should I do this? And you can say there is no like right or wrong here, as long as you do it regularly, you can say. I put in a real life example here as well to see what are the actual benefits. Here, this is just a simple example I calculated on the 50-50 portfolio over the last 25 years. So if you just put in 50% equities, 50% fixed income in like global indices 25 years ago, what would then have happened? So say in the top chart, you can see the no rebalancing part. So you would quickly go to about 70% equities, and then it would start, or 70% bonds, sorry, because after the crash of the IT bubble back in the early 2000s, then equities lost significant amounts, and there you can say you actually end up with around 70% stock fixed income there, and then you have a hard time coming back. But if you rebalance, for example, every 6 months or every time your portfolio drifted away 5 percentage points from your original target, then you would, as you can see, stay somewhat in around your, you can say, initial target. I put in the returns as well, and you can see the maximum level of equities and minimum level of equities. So you can see if you didn't do anything, you will end up with a 230%-ish return. The return is actually slightly higher for those who rebalance regularly, either whether you did it biannually or whether you did it with this 5% threshold. But what is also important is that you can see that whereas the no rebalancing drift between 25% equities and 67% equities, the other ones are all the time around the 50%, which means that your risk level is kept intact all the way. So this is actually, say, over time, keeping your risk intact, and in this example, the return is actually also better. But that, as I said in the beginning, also depends a bit on the period that we are looking at here. But this is just an example of why it's important, such that we keep track on and this is of course only looking at asset classes. As we talked about before, it should also be done on you can say sector level, regional level, individual security level, etc., to make sure that everything is intact. Because if you only invest a large portion into tech equity or tech stocks, then it would also drift out of line or something like that. So it's important to have like a holistic view of the portfolio over time.
And if I may just kind of in closing out the thought, Jakob, right? I really like the point here around plus or minus 5% or every 6 months. Again, not that they have to be that, but the reason why I think to hit home is that we're trying to take the subjectivity out, right? The point here that you said before about the fear of missing out, right? It's the whims of the market. It's the market's going really far down, the market's going really high up. It's how do you ensure that you're just sticking to the objectives that you set for yourself? And that's actually one of the things that I love about in the United States, right, where we have our retirement accounts, that every 2 weeks when we get paid, we're getting an allocation at the exact prescribed amount that we set up, right? So when we're getting it, it is always the same, and nothing is going to drive that and change that. And I think that's the key to remember, right? Is that what is the allocation I'm looking to achieve, and why, and really just sticking to that mandate, no matter the whims of what's going on. I know it's not easy, right? But I think that's the point. And again, to one last thing too, that Jakob was showing, right, the better returns. Sometimes that's not, I guess, yes, everyone always wants higher returns, sure. But sometimes it's the smoother ride, right, that people want. And that's why they have a certain objective lined up that, again, they want to what Jakob was hitting at before with me too, is right. You want lower dampened volatility, smaller moves in the marketplace that will require, right, different allocations, and really trying to stick to them.
All right, so thank you very much, Jakob. It was quite interesting to see those charts and visualize the differences between rebalancing and not rebalancing. But now let's hear more about how the professionals do it, namely NASDAQ. NASDAQ is a world-renowned exchange and an index provider. Most of you probably have heard or know about the NASDAQ 100 or the NASDAQ Composite. And the question here to Ilaria is, are the NASDAQ indices periodically rebalanced? And if so, why? We cannot hear you, Ilaria, sorry. Same thing, we cannot hear you.
Can you hear me now?
Yes, now it works.
Okay.
Great.
Do you mind sharing your screen, Ida, with the slides?
Yes.
Okay, if we move on the next one.
Yes.
Before answering the question, let's try to understand the similarities between an index and a retail portfolio. Both are designed to track the performance of a group of securities in a specific market, sector, theme, and both are designed to achieve a specific investment objective. Another key similarity includes periodic adjustments. So just as individual investors periodically adjust their portfolio to maintain a desired asset allocation, risk-return profile, as Jakob explained before, indices also undergo periodic rebalancing to ensure that their composition is aligned to their methodology and final purpose. The key difference is that indices will follow a predefined set of rules, as Ephraim explained before, rather than discretionary adjustments made by individual investors. So how can we, as index providers, ensure that we keep an index relevant and accurate? We can do that via two different processes: index reconstitutions and index rebalance. Index reconstitutions involves a comprehensive review of potential replacement of index components. It's mainly driven by broader eligibility criteria that could be market cap, liquidity, sector representation, etc. New securities might be added, existing companies may be removed based on such criteria. And usually reconstitution happens less frequently than index rebalance. Index rebalance, on the other hand, is a regular review to adjust the weights of existing components within the index to keep it aligned with the methodology. But why is this important? Because as market evolves, the value of securities within an index will naturally fluctuate. And these over time these fluctuations will cause the index to drift away from its originally design and objectives. So index rebalancing ensures that the index maintains the intended market representation, and it ensures that the current market conditions are reflected. Reconstitution and rebalance can happen together, but often they occur at different times. And it depends on the index purposes and methodology. If we move on the next slide, and to go back to the second part of your question, Ida, how often are indices rebalanced? Short answer is it depends. There might be different factors that could impact the frequency and approach to rebalancing. And we're talking about the weighting schemes, how stocks are weighted, the scope of rebalancing, what is adjusted, and the selection criteria, so how constituents are chosen. But the most important message here is that understanding what there is behind rebalancing, so the different mechanisms, methods, can help you to gain insights on how these events may affect indices, funds tracking those indices, and ultimately your portfolio. Because we may have shifts in composition, addition, removal of components, weight adjustments. We could have a potential market impact. Let's think about large-scale rebalancing. They could influence in the short term stock prices, trading volumes, liquidity, and potentially causing short-term market volatility. So if we move on the next slide, we can start to talk about one of these factors that could impact the frequency and approach of rebalancing. So we're talking about the weighting schemes, which determines how stocks are allocated within the index. So if we move on the next slide, today I would like to present 4 different weighting schemes, and we are going to see how each one of them may impact the frequency of rebalancing. So let's start with the first example, free float market cap without capping. And we can talk about the Nasdaq Global Index as an example, an index that encompasses approximately 98% of the investable market cap globally across large, mid, and small cap companies. The weights are assigned based on the market cap of companies, and it is adjusted for the shares available to the public, so the free float. There is no capping, meaning no upper limit on how much weight a single stock can have in the index. This, on one hand, may lead to higher concentration in larger companies and potentially impact diversification. And also the performance of the index could become more sensitive to large stock performance. But at the same time, it may provide an unfiltered reflection of market trends, and this can reduce the need of frequent rebalancing, frequent adjustments, as the weighting naturally shifts as stock's price fluctuates. If we move on to the second example in this slide, so market cap, but this time with capping, and one example is the Nasdaq 100 index. The initial weights of each company are still determined looking at the free float market cap at rebalance date for each companies, but these initial weights are then evaluated to meet 2 constraints. There is a cap, there is a limit on the maximum weight a single stock can have, and this threshold is set to 24%. And then the top companies' combined influence is also constrained. In particular, the aggregate weight of those securities whose weights exceed 4.5% may not exceed 48%. What does this mean? That the top companies in the index will still have a significant influence, but their combined influence is constrained. With this capping, we may have a less accurate reflection of market dynamics, but it may help to control concentration risk, and it may help ensure better diversification. And on the other hand, these capping rules may require a more frequent rebalancing just to make sure that these thresholds are met. This particular index rebalanced on a quarterly basis in March, June, September, and December, and only reconstitutes annually in December.
Ilaria, one quick question here. Sorry, that was a very important point. So you were talking about market cap. Is this the case for the Nasdaq 100 index? Because that's when the name that you have at the bottom here.
Yes.
Okay, great. Thank you.
Yeah, the names that you can see on the slides refers to a specific example for each weighting scheme. So the third example, the purple one, is the Nasdaq Clean Edge Smart Grid Infrastructure Index, and this is an example of market cap with multi-level capping. So we are not only control individual stock weights, but also sector exposure. The index tracks global companies active in the grid infrastructures, smart meters, energy management, and related activities. Interesting thing is that the index distinguishes between pure play companies, which derive a significant portion of their revenues from the smart grid sector, and diversified companies, which have a broader business operation but still have exposure to the smart grid sector. Initial weights are allocated, and initial weights depend on the free float market cap of such securities in the index, but then they are adjusted to reflect this multi-level capping. Pure play companies will receive collectively % of the index weight, while diversified security will receive the remaining 20%. This can ensure that companies most focused on the smart grid sector will have a greater influence on the index. In addition to this, we may have individual caps within each group to prevent any single company from having too much influence. And this can help us to maintain a balanced and diversified index. And as the previous case, this multi-level capping will require more frequent rebalancing schedule. This index, in particular, reconstitutes semi-annually in March and September, and it's quarterly rebalanced. Finally, let's see the last example for weighting schemes, equal weighting. And let's talk about the Nasdaq 100 equal weighted index. Same components same securities as the Nasdaq 100, but each component is given the same weight of 1%, regardless of market cap. So as you can imagine, this may require a more frequent rebalance, often quarterly, to restore equal weight, as stock prices will fluctuate, will change, and this will cause weight imbalances. This particular index has been launched to offer investors an equal weighted alternative to tracking the same innovation-driven companies that are part of the Nasdaq 100, but with much lower level of concentration in terms of sectors and individual company basis. Indeed, if we move on the next slide, we can see that, for example, the top 10 names concentration goes from 55% to 10% in the equally weighted version. And if we look at the tech sector exposure, it goes from 60% in the Nasdaq 100 to 44% in the equally weighted version. So if we move on the next slide, we have talked about, how different weighting schemes can impact the approach and frequency of rebalancing. But let's now discuss about another factor, which is the scope of rebalancing. So what gets adjusted? We can have a whole, so entire portfolio rebalancing, or a partial rebalancing via sub-portfolio. And in the next slide, I will try to explain to you how this sub-portfolio rebalancing works and potential implications for investors. So what does this mean? That instead of fully rebalancing the entire index or portfolio at each rebalance stage, sub-portfolios are rebalanced in a staggered manner. These sub-portfolios are rebalanced periodically, but only a portion of the total index changes at each rebalance. What could be an impact on investors? Well, this approach may help to lower transaction costs, since fewer assets are trading during each rebalance. This approach may also help investors to have exposure on a specific strategy on a rolling and continuous basis without altering the entire portfolio structures. And finally, this portfolio approach may allow investors to have more name within the same strategy. Because if rebalancing occurs less frequently, and if we rebalance the entire portfolio or index, only names eligible to be included in those fixed dates can enter the index or portfolio, limiting the overall exposure to different stocks over time. But this sub-portfolio approach may allow new qualifying stocks to be added more dynamically. And of course, this can impact diversification. At Nasdaq, we have an example that is the Nasdaq US High Equity Income Index, which employs a unique construction approach based on sub-portfolios. So the index is divided into 6 equally weighted sub-portfolios. Each sub-portfolio contains a selection of stocks chosen on factors such as liquidity, dividend yields, quality screens. So the index is rebalanced monthly, while each sub-portfolio is rebalanced and reconstituted semi-annually, as you can see on the picture on the right-hand side of this slide. What does it mean? That every 6 months, the stocks within each sub-portfolio are evaluated and adjusted to ensure that they meet the index criteria. So I think now if we can move on the next slide, we are ready to talk about the last factors that could impact the approach and frequency of rebalancing. So I'm talking about the selection criteria, how stocks are selected. That could be selected by market cap or using less common factors such as the patent filing activity. And in the next slide, I will present to you the Nasdaq Global AI and Big Data Index. Before starting, let me tell you that this is one of the most complicated that we have built in-house. That's why I will try to give you an overview, but if you are interested in the detailed methodologies, at the end of this presentation, you can find a slide with relevant links. So how securities are selected? They are selected if they have recorded recent and relevant patent activity. The index would exclude companies that have not filed a patent in the most recent year. That's why this index is really focused on companies that are actively engaged in pushing the boundaries of the technological progress. This index, in particular, tracks the performance of companies that are most active in filing patents related to 7 disruptive technologies that has been identified to be the most, let's say, relevant to the advancement of AI and big data. And you can see these disruptive technologies on the right-hand side of the slide. We're talking about deep learning, cloud computing, cybersecurity, NLP, big data, image recognition, and speech recognition. An important step to mention is that at Nasdaq, we have an in-house AI team, which is able to process thousands of patents globally. And they do this using a rolling 12-month look-back period, and they repeat this analysis on a quarterly basis. So the AI team has trained their model to read and classify such patents into 35 disruptive technologies, and we have identified 7 related to AI. Once this classification is done, each company will receive 3 important scores. Important because they will determine which stocks can be selected in the index. I'm talking about the pure score, contribution score, and intensity score. The pure score is a measure on how intensely a company is engaged in a theme with respect to all other themes for which it has a recorded patent activity in the last 12 months. The contribution score indicates, on the contrary, how much a company contributes to the total number of patents filed by all the companies on the same theme. And finally, the intensity score is calculated and it measures the number of sub-theme or relevant technologies where the company is involved in based on recent patent activity. If we move on the next slide, let's see in details how companies are selected within the index. Well, constituents are selected based on the strength of their pure and contribution scores, meaning that both must be in the top 50th percentile to remain in the index, and for new addition, they must be in the top 35 percentile. So at this point, we have selected companies that are eligible to be included in the index. The maximum number of securities in the index will be 100. So at this point, the intensity score, the average contribution score, and the ADTV are also used as tiebreakers for selection. This is very complicated. This is done every 6 months as the index rebalance and reconstitute semi-annually. to make sure that we select companies that are relevant in this space. That's it, Ida.
All right. Thanks, everyone. I'm so sorry to the audience. We are running out of time. We have a number of questions. I think we'll get back to you by email. It's on us, so we'll definitely do that. Before we close, I have, however, one question, and that would be for all of you. What are the common mistakes that we must avoid when we monitor and rebalance a portfolio? And before we start, I'm just going to pull up the QR code for the survey. And please just give us 2 minutes to answer the survey while our speakers answer the question. What are the common mistakes to avoid when monitoring or rebalancing a portfolio?
I guess maybe I'll jump in and go first. I guess I think Jakob did a great job kind of hitting on some of them, and maybe I'll just kind of reiterate my favorite couple here. But the fear of missing out, right, and just not letting subjectivity get in the way of your ultimate objective. I'd say those are kind of the two. One kind of very interrelated, but those are kind of the main things that I would say. And I'm love to hear what Ilaria and Jakob have to say too.
Yeah, I think to add a point that we talked about and Ephraim also mentioned before was like focusing solely on returns. I also think that's a kind of a mistake that people tend to do. So you need to see that in relation to the objectives that you have, in relation to the time horizon that you have, to your risk profile, your risk tolerance level, all of that. So don't just chase the last say comma of returns. You need to look at the risk as well, and you need to have like a holistic view of your portfolio. And then echoing what Ephraim is saying, like avoiding those emotional biases, because it's really a tough thing when we talk about this rebalancing.
One thing I would say, one of the mistakes is to ignore market trends. So while timing the market can be risky, ignoring it or ignoring, broader trends can lead to poor positioning. So one general advice is stay informed, keep up with financial news, market trends. And this doesn't mean that you have to react to every single market movement, but in this way you can be aware of any significant changes that may warrant a review or a monitoring of your portfolio. You're muted, Ida.
All right, we are definitely out of time. Thank you to all the speakers for your time and sharing your knowledge. And thank you to all the attendants for joining us today. The recording for the webinar will be available on the platform tomorrow. Thanks again, and take care of yourself. I'll pull up the QR code again.
Thanks so much.
Thank you.